Why are banks collapsing? Several banks have failed recently and have threatened a major financial crisis, prompting US authorities to launch emergency measures on Sunday. This week, two of the largest bank failures in history occurred. Markets are concerned about other banks failing after Silicon Valley Bank, Silvergate, and the Signature Bank collapsed in New York. Join us as we discuss what caused the bank's collapse. Why did this happen? Let's dig into it.
Biggest bank collapse in U.S. history.
It is the epicenter of tech startups, venture capital, Silicon Valley Bank. It is the 16th largest bank, or it was, in the United States.
The collapsed bank had invested in around 21 Indian startups.
The bank stock lost 80% of its value this week, 60% in one day alone.
The management of these banks will be fired. Investors in the banks will not be protected.
During the current crisis, Silvergate announced that it would be winding down its operations on March 8th after its customers fled. Most of the bank's business was in cryptocurrency industry in Lajula, Caliph. Later 2 days, US regulators closed Silicon Valley Bank. Joe Biden, the US president, has promised to act against those responsible for the country's banking crisis after two of its major banks collapsed in 3 days. New York regulators closed Signature Bank on March 12th over fears it would run out of cash due to customers withdrawing money in piles. Cryptocurrency clients dominated the bank's business. Chapter 1. What caused the bank's collapse? This could be due to a deeper issue involving shady balance sheets, record inflation, and rising rates in American banking. Last week, Martin Grunberg, the chief of the Federal Deposit Insurance Corporation, FDIC, warned about a $620 billion risk lurking in the US financial system, which culminated in the collapse of 3 banks, including Silvergate Capital Corp. Investing in stocks or other securities is something you decide to do. Don't pay enough attention to the risks inherent in the security before investing your savings. For a while, everything seems fine, but suddenly everything changes. Your security's value is crushed by factors that you didn't consider, which you didn't anticipate. Most portion of your investment is lost. The banks did this without really thinking about the risks. They placed bets without really understanding what was at stake. Taking SVB as an example, the bank invested some of its cash in government-guaranteed residential mortgages. During the pandemic, SVB bought bonds at very low interest rates. However, interest rates jumped as the Federal Reserve had been combating inflation since 2021. Since bond prices fall as interest rates rise, older bonds with low interest rates can be sold only at much lower prices than new bonds with higher interest rates. SVB's investments in mortgages are even more sensitive to interest rate changes since people are less likely to refine their mortgages when interest rates increase. As another problem, SVB hadn't considered that most of its customers, tech companies, would at some point face cash flow challenges. The economy slowed after the pandemic, but tech startups prospered during the pandemic. Their projects were unable to be funded due to a lack of funds. Their expenses were not covered by their deposits with SVB, so they began to dip into them to stay afloat. The result was that SVB was forced to sell the low-interest bonds they bought at steeply discounted prices to meet their clients' increasingly hefty withdrawal requests, resulting in a financial loss, according to Maurice Pearl, former managing director of BlackRock and Patriotic Millionaires Chair. By the time, SVB had no choice but to close its door because the situation became so worse. Chapter 2. What kind of bets did all the banks make? Most banks would be surprised if they didn't invest in treasury securities and interest-bearing accounts created by the Federal Reserve. Due to interest rates at almost zero until the second half of 2021, they benefited enormously from not paying anything for their deposits. What's the point of borrowing at essentially 0% when you can earn 3% or more at the Fed? Unlike the startup economy, big banks are diversified and don't depend on a single economic sector. A risk management team is also in place at the company. There was no chief risk officer at SVB for several months. Only in January did the bank appoint one. Chapter 3. What is causing bank stocks to fall? According to investors, the risk of contagion, the possibility that many other banks will follow the 3 recent ones, remains. The main question they ask is whether more banks hide unpleasant surprises from their customers. Their ignorance of SVB has taken them aback. and they are frightened of what they don't understand. Because of this, they have targeted banks that have been experiencing long-term problems or are perceived as weak links. The Credit Suisse scandal, which has plagued the bank since 2021, is an example of this. A bank with a profile like SVB or Signature Bank in New York is targeted by investors in the United States. Banks of this type are known as regional banks. Banks face interest rate risks when rates rise rapidly within a short period of time. This is exactly what is happening in the United States. The Federal Reserve has been raising rates aggressively since March 2022. A rate increase of 4.5% has been implemented so far by the Fed to control inflation. There has been a commensurate rise in rates as a result. According to the AP, the yield of one-year US government treasury notes reached a 17-year high of 5.25% in March 2023, up from less than 0.5% at the start of 2022. There has been an almost 2% increase in the yield on 30-year treasury bonds. A security's price goes down as its yield rises, which brings about a chair reason. An increase in rates of this magnitude in a short period of time causes the market's value of previously issued debt to plunge, particularly longer-dated debt. According to an AP explainer, a 2% increase in a 30-year bond's yield can cause its market value to drop by around 32%. It is not a big problem if interest rate risks reduce the market value of a security as long as the owner holds onto it until maturity, at which point the owner will be able to collect its original sum without incurring any losses. The bank's only losses will remain hidden on its balance sheet and will disappear over time. Nevertheless, if the security must be sold before maturity at the same time the market value is lower than its original face value, the unrealized loss becomes an actual loss. As a result of their own cash shortfalls, Silicon Valley Bank began withdrawing their deposits when interest rates were high, resulting in a massive showdown. Banks and customers are being put at risk even as regulators wonder if their measures are effective enough to protect them. Chapter 4. Banks' reactions. What are the authorities doing? It has been reported that some targeted banks have enough funds and different sources of financing to respond to massive withdrawals from their customers. According to Credit Suisse, a government bailout was not a topic which indicates the bank was confident that it could manage independently. An emergency plan has been unveiled by US regulators. Regardless of the amount of the deposit, all deposits are guaranteed under this program. There was a limit of $250,000 on the FDIC's deposit insurance before. A facility of last resort has also been created by the Fed to lend money to banks in need. To avoid a similar financial crisis to 2008, the Fed is ready to print as much money as possible. Let's talk about liquidity risks. In response to the SVB customers withdrawing their deposits beyond what the bank could pay with its cash reserves, the bank sold $21 billion of its security portfolio at a loss of $1.8 billion to meet its obligations. According to the AP, the lender attempted to raise over $2 billion in new capital because of this drain on equity. SVB's customers were already losing confidence in the bank and rushed to withdraw cash when the call for raising equity came. The digital age has enabled even the healthiest of banks to go bankrupt a matter of days after a bank run. Let us remind you that the banking crisis isn't over yet. A rate hike by the Federal Reserve today puts some of the bank's holdings at risk of interest rate increases. As a result of the US government's decision to backstop all deposits at SVB and Signature Bank, banks with less cash and more securities on their books are less likely to face liquidity shortages due to panic-driven withdrawals. Despite this, the current US bank data shows that over $1 trillion in bank deposits are uninsured, which raises doubt about the end of the US banking crisis. There has been no banking failure of this magnitude since the financial crisis. Creating a bank term funding program may not go as smoothly as promised or may take longer than expected, which could lead to devastating consequences for companies across the country. The Federal Reserve has some responsibility for the macroeconomic situation, however, something needed to be done. We guess this sends a clear message to people who are wealthy to move their money into big banks. Otherwise, you may end up feeling like Jim Cramer. Please subscribe to the channel and press the bell icon to stay up to date with future videos. Until next time, good luck.